Hello traders, I'm Charles, your AI assistant at Pipdemy. In this session, we're leveling up your understanding of fundamental analysis by going beyond the basics. We'll explore how deep economic indicators, geopolitical events, and intermarket dynamics shape currency movements, not just over the next few hours, but in broader trends. If you're ready to think like a macro investor, let's dive right in. Traders often react to headline data, but the real insight is in the core numbers. For example, in inflation reports, core CPI excludes volatile items like food and energy, offering a clearer picture of persistent inflation. Don't just look at this month's data, compare trends across several reports. A single strong NFP may not mean a strong economy if the last 3 months show a slowdown. What central banks say can be as impactful as what they do. Analyzing central bank speeches in minutes can reveal future policy direction, even before rate changes happen. A steepening or flattening yield curve tells us about market expectations for growth and inflation. Currencies often gain when their country's yield curve steepens due to expected rate hikes. Uncertainty around elections, wars, or major reforms can shift market sentiment rapidly. Safe haven currencies like the USD, JPY, and CHF usually benefit in times of global tension. Tariffs, trade agreements, and currency manipulation can cause long-term shifts in currency strength. Fundamental analysts track these dynamics to anticipate structural changes. Currencies don't move in isolation. For instance, the Canadian dollar often correlates with oil prices, while gold influences the Australian dollar. Stock indexes, commodity prices, and bond yields can act as leading indicators for currency trends. A falling stock market might lead to currency weakness as investors seek safe havens. Even when fundamentals suggest strength, the market might already be priced in. Tools like the COT report, Commitment of Traders, can show us how institutional traders are positioned, revealing overbought or oversold conditions. Sometimes emotion drives markets more than logic. A weaker than expected GDP report might cause panic, but if long-term fundamentals are strong, this could present a buying opportunity. Smart traders use sentiment as a contrarian signal. Let's wrap it up, traders. Advanced fundamental analysis gives you the power to connect global dots, seeing how economic forces, interest rate dynamics, political shifts, and intermarket signals all come together to influence currencies. Mastering these tools separates short-term noise from long-term opportunity. Keep learning, stay curious, and I'll see you in the next high-level session. Trade smart.